What if you could get a look at the entire investment playbook of a 36-year-old who's built a $40 million net worth? Well, today, that's exactly what we're going to do. We're breaking down everything from his stocks and real estate to some pretty unexpected assets. And to kick things off with the same energy as the investor himself, holy smokers, that ain't no jokers. That just perfectly captures the bold, kind of unconventional approach we're about to unpack. So let's dive right into his strategy, starting with his predictions for the market. So where does a guy with a $40 million portfolio see the market going? Let's take a look at his 3-year price targets for some of the biggest names in tech. Okay, he is starting off with a massive call here, a 3-year price target of over $1,200 for Meta. Now, a lot of people are worried about their spending, but he thinks Zuckerberg's going to tighten the reins, which will let the company's incredible 25% growth rate just propel that stock to brand new heights. Next up, we've got Amazon with a target of over $400. So why is he so bullish? Well, it's the reacceleration of AWS growth, plus the strength of their e-commerce and ad businesses. And here's a really interesting tidbit he points out. Amazon stock, it tends to make these sudden explosive moves after just sitting there, sometimes for a long, long time. But his most aggressive target, by far, is for AMD, over $500 in the next 3 years. And he thinks it could maybe even happen within 1 year. That is a huge jump. So what's the logic behind a prediction that bold? Okay, so here's the crucial point. It's not just about AMD's own tech. AMD plays this vital, strategic role for giants like Microsoft, Meta, and Google. See, by giving them a high-end alternative, AMD basically forces NVIDIA to be more competitive on price. It keeps them from having a total monopoly. And that makes AMD pretty much indispensable to the whole industry. And his predictions aren't just limited to big tech. He sees Celsius hitting over $100, Salesforce at $350 plus, and, get this, he thinks Cheesecake Factory could more than double to $110. He's also really bullish on SoFi and sees a huge jump ahead for Honest Company. But, making smart predictions is only half the battle. A core pillar of his philosophy is knowing what not to invest in. And this is a spot where so many people get it wrong. Understanding the massive difference between a luxury purchase and a real investment. His rule on this is simple. It's crystal clear. Luxury items, things like watches, bags, cars, those are YOLO purchases. You buy them for enjoyment, period, not for financial gain. They are expenses, plain and simple. They're not assets. And this slide just illustrates his point perfectly. Instead of buying a Rolex and just hoping it holds its value, buy stock in the company that actually makes the watches. Instead of a Birkin bag, own Hermes stock. The principle is so simple. Invest in the businesses that create the value. Don't just consume their products. And he absolutely practices what he preaches. He owns 2 expensive watches, a Ferrari, and a Tesla. He enjoys them for sure. But he is under zero illusion that they're investments. They're just things he bought because he wanted them, and that is a crucial distinction to make. Okay, so with that whole philosophy in mind, let's look at where he actually puts his money. This is the complete breakdown of his multi-million-dollar portfolio, and we're starting with a big one, real estate. His real estate holdings are substantial. He's got 2 investment properties with over $1 million in combined equity. His primary residence holds another $1.5 million, and right now, he's building a new $5 million home. So yeah, clearly, real estate is a major pillar in his wealth-building strategy. Now we get to his more unconventional assets. He bought 300 ounces of silver, making a bet on the gold-to-silver ratio and using it as a hedge against inflation. And then there's this, a sealed, mint-condition Pokemon booster box from 1999, which is now worth around $30,000. Wild. And his core stock portfolio, well, it shows he puts his money where his mouth is. You can see those big bets we talked about earlier, Meta, AMD, and Amazon, right there at the center, surrounded by other tech giants that really fit his long-term growth strategy. But here's something you might not expect from such an aggressive growth investor. He keeps over $1 million in cash. That's right, just sitting in high-yield savings accounts. And he has a very, very specific reason for it. You see, that cash isn't just sitting idle. It's buying him peace of mind. Like he says, he just can't see himself ever dipping below that $1 million mark. It's this powerful safety net. And honestly, it's what gives him the confidence to invest so aggressively everywhere else. So we've seen his predictions, his philosophy, and his portfolio, but what are the key lessons we can really learn from his incredible 17-year journey to building all this wealth?
First, you have to remember where this all started. I mean, this was not an overnight success. It began 17 years ago with a job that paid just $8.75 an hour. That's just a powerful testament to the importance of consistency and having a long-term vision. When it comes to his financial peace of mind, he really boils it down to two key habits. First, making weekly buys into the market. It just eliminates all the stress of trying to time things perfectly and keeps him constantly on the offense. And second, maintaining that $1 million cash reserve, a safety net that gives him years of security and the freedom to take those calculated risks.
So, after this deep dive into his entire playbook, what's the single most important thing to take away from all this? It all comes down to this one powerful idea. We so often get caught up in the short term, but real, lasting wealth just isn't built in a single year. His journey is proof that with consistency, discipline, and a long-term perspective, what you can achieve in a decade is so much greater than you can possibly imagine. So, the real question is, what are you going to build in the next 10 years?